Okay, good. All right, so let's go ahead and let's take a look at chapter here, this chapter 8 material. And what we're talking about in this chapter is fixed assets. Okay, so when we talk about fixed assets, they have the term fixed because they're relatively large items like a building, for example, like some land, okay, like a piece of equipment, large durable items. These items tend to be considered non-current, and that we are sitting here and saying, hey, this thing is probably going to be available to us beyond the current year. And now remember, we had talked a little bit about the notion of current assets. Current assets are those things that will be consumed in a year or less. For example, cash is almost always current unless there's some restriction on it that's been placed on it by somebody. But cash is almost always current. Receivables are current, right? We pretty much expect our receivables to be paid off in 30 days. Inventory is current. If you're Nordstrom or like that, you don't want to be stuck with next year's fashion. So your inventory is probably going to be a more current item. Okay. Now, assets have future economic benefit, but as that future economic benefit extends beyond the current year, longer term, then we start to call those fixed assets. Equipment, building, land are typical examples of current items. And then if I had an investment, say I bought stock or have bought something that I've acquired and I plan to hold that for longer than 1 year, that is also considered non-current. Okay. Now I put this picture of the railroad up here, saying what's up with this railroad stuff, why are we having that up there? And prior to the construction of the railroad, okay, companies typically would just go ahead and expense any money they spent, even if it was going to be on some asset that was going to have this long economic benefit. As tremendous amounts of cash were being paid out to construct the railroad across the country, that's when companies started saying, wait a minute, we need to reflect differently what's going on here. We've got this asset that has this extensive future economic benefit, not only to the company, but maybe the country, unless you were the indigenous people that they were rolling over as they constructed that. But that aside, we're going to go ahead and we're going to start recording these assets. But then consistent with the idea of assets, we will have what? We will have depreciation. Okay, so much of our discussion here in this chapter is going to be about depreciation. But let's just go ahead and stop for a second. Really? One second. Okay, wasn't too bad. Okay, so let's just go ahead and stop for a second and just take a look at, we have our different classes of assets. Yeah, I have there. Who is that? Okay. And you can see the different costs that will go in. And let's start with land. Okay. Now, the way to think of the cost of land is, I don't know if you've ever bought a new house or something and you go to a new, development and you look and they say, okay, well, what lot do you want to pick, right? You start driving around and you see all these nice flat pieces of land, house to be built on top of it. Okay. Any cost that got it to that stage where you could start building a piece of, start building a building or something on top of it, that's part of the cost of land. So you take a look, purchase price, sales taxes, permits, broker's fees, okay? Removing unwanted building, okay? Grading and leveling, getting it nice and flat. All that is part of the cost of the land. Now, it's important that we understand the difference between the cost of land and the cost of the building, because what? We don't depreciate land, we will depreciate the building. And so we need to sit there and break those two out. So you start looking and they start talking about, let's jump over the building, architect fees, engineer fees, okay? Interest, if you borrowed money to construct that, you can go ahead and capitalize that interest as part of the cost of the building. Repair that had been neglected by the previous owners, okay? But a way to think of this, if we're thinking of the cost of the land being anything that you had to put to get the land nice and flat, as you start digging a hole for the foundation, that's part of the cost of the building at that point. You start doing things that had nice flat land so that you can begin construction is part of the cost of that building. Notice, guys, land improvements. If you're putting lights, sprinkler systems, landscaping to that nice flat piece of land, that is part of the cost of the building, the improvements, and they will be subject to depreciation. Equipment has rules that are very similar to what we had talked about for inventory. Remember, I said any cost that you incur to get the inventory to your business so you can use it in your business is part of the cost of that inventory, is part of the cost of that. Same rules apply for equipment. So if you had to have the equipment delivered, if you had to assemble it, if you had to install it somehow to your factory, all of that is part of the cost of the equipment. Okay. Question. Okay, good. Now you come over and I'm not giving you a test question here. I'm simply putting this up so you can kind of get a sense as to what different costs would go into a building. Okay, as we go through and look at this, at the land. Okay, this was a question that I took from CPA prep material. Okay, so on December 1st, year one, Boyd Company purchased $400,000 tract of land for a factory site. Boyd raised, that means tore down, right, an old building on the property and sold the materials it salvaged from the demolition. Boyd incurred additional costs and realized salvage value proceeds as follows. Okay, so if you just look at the explanation, land 400, yeah, right, the invoice price of the land, the demolition cost, yep, that's part of the cost of the land because we tore down an old building so we could get the land nice and flat so we could begin building on it, right? The title, legal fees for purchase, title guarantee insurance, yeah, take the land clear and free of title, that was part of the cost of the land. And then the proceeds from the salvaged materials actually come off of the cost of the land because you got some money back, right, on that building. Okay, just showing you a way that an accountant might go through and consider these different costs to properly categorize them into the land. Okay, question? Okay, good. Now, if we're dealing with a fixed asset here, notice they tell us, and this is a different provider that borrowed these textbook providers. I used to have textbook providers come in and start to tell me this, tell me that. And I tell them, here's what you need to do. You need to put a statue up of me somewhere because I'm using your textbook at all kinds of different schools. And all kinds of good stuff that way. So they never did put a statue up of me, but I thought they should. Okay, so what happens? $12,000 is the amount of equipment. Okay, the invoice price. Freight cost, we had to pay $600 to get this thing to where we could use it at our factory, whatever. Installation cost of $1,500, including $500 due to an error in installation. So what would be the correct journal entry? And we're going to take off that $500 when it's a one-time deal, an error like that, you don't include that. Okay, that would be a period expense at the period that it happens. And so we would debit cash for the 13.6 and debit cash, credit cash for 13.6, debit the equipment. Okay. Okay, good. So that's just how we capitalize. We put something on the balance sheet when we purchase it. Now that we have that future economic benefit recognized on the balance sheet, we are going to have to depreciate this item over time as its future economic benefits slowly expires, slowly disappears, okay? So you take a look and we remind you that we don't have depreciation for land. Land is assumed to last forever. Sometimes I'll have a student say, well, wait a minute, I saw something where the land and it fell in and everything fell in underneath it. What do you do then? Well, you would record that loss at the time the sinkhole swallows everything. Okay. The assumption is it's going to last forever, right? Okay. Now, because we have, other than land, we have depreciation, we need to consider certain things. For example, we'll start with the cost of the asset. We need to estimate the useful life. How do we estimate the useful life? Maybe this isn't the first time we've had this kind of equipment. Maybe we've had other vehicles where this is, and so we go off of our experience. Or maybe we call around and we say, hey, how long does your truck last, right? Or maybe the manufacturer will tell us, hey, how long do you think this thing is going to last, whatever. Okay, but we have to have a reasonable way to estimate its useful life. And then we estimate the salvage value. Salvage value is saying, hey, after you're pretty much done using this thing and you plan to get rid of it, what can you get back? Again, this is an estimate that is based on our experience with the other assets, etc. Okay, so we come up with these different amounts. And in this particular example now with this truck that we're going to look at, the original cost is $13,000. So I'm assuming that they went ahead, just going to call it truck, whatever. Okay. I guess I could call it. Okay, I'm assuming they paid cash for it. I'm going to put cash up. They credit cash. They debit the equipment for $13,000. Okay. Now they have these different estimates that they're using. They have what? They have salvage value of, what's the salvage value? 1,000. They have what? They have the useful life of 5 years estimates, right? And then they will use, they have the estimated use in miles, 100,000, and they will use this information to calculate depreciation. And what we're going to look at here are 3 different methods for calculating depreciation. Okay, one is called straight line, the other is called units of activity, and the third is called declining balance. Okay. Now, I don't know if you should trust the percentages on this slide. Anytime I see a slide that starts 98% of something is a certain amount, and then they don't source it, I start to get a little suspicious. So I don't know exactly where they got this, whatever it is, 83%. But I think it is reasonable to expect that most companies will use straight line. Most companies use straight line because it is the easiest, most straightforward method and widely accepted method for calculating depreciation. Units of activity, okay, let me say 5%, and declining balance 4%. We'll look at each of those. And then there are other boutique methods that people use that we're not necessarily talking about here. The big one is what? Straight line. Okay, so you start to take a look. And straight line, okay? And what we do is we take the original cost, that's that 13,000 that we had purchased the equipment for. We subtract the salvage value. That gives us the depreciable base. That's saying that's the part that we're actually going to use, right? Okay, so if you take that 12,000 and divide it by 5, that's telling you that this asset will depreciate $2,400 per year. Okay. Now, when you take a look at this schedule here, this is.
Can you go back for a second?
Yeah.
How is salvage value?
How's it what?
Fine.
Salvage value is an estimate of what I think I will be able to sell this asset for essentially after I'm done using.
This volume, but the asset never increased in value.
They are estimating that this asset will not increase value. Yeah. Yeah.
At the end of its work to increase with that same rule.
It would be a little odd to have a piece of equipment that I'm using in the business and then start to determine that I think it's going to have some sort of increase value. I mean, people don't usually use, antique trucks to deliver furniture or something, right? So if I was making some sort of investment in a work of art or something, I may not depreciate it at all, right? Because it's going to increase in value. Uh, you know, assets that we're talking about here really should be perceived more as something that's being used.
To decrease.
Huh?
To decrease.
It's gonna be decreasing because, the notion that you're buying a piece of equipment and it's gonna get torn up over the next 5 years and so forth, and not have the same value that it had today. Right? If it was a piece of art or something, then I'd start to get into works of art, right? Or if it was a stock, there is no useful life in this stock. If I was buying that as an investment, and so I would go ahead and, simply reevaluate the fair market value of that each period. And I would carry that at fair market value because it has a readily determined value that everybody agrees to, right? Remember, we said in our first discussion, we use historical cost or fair value, and I said if things like security or something, I'd use fair value. Okay, but what we're talking about here is more property, plant, and equipment that I'm using day to day in the business, and so it's probably going to depreciate in value. But I still think after I'm done, I might be able to get $1,000 for it. 8,000. Okay, and so I'll take that 12,000, and again, the salvage value is an estimate. The useful life is an estimate. Estimate that my asset is expiring, future economic benefits expiring at $2,400 a month. Okay, now as I go through now, and I calculate that depreciation, and this next slide kind of shows you another way to look at it. If it's a 5-year life, guys, 1 divided by 5 years means the thing is depreciating 20% a year. So that's where that 20% came from. 1 divided by 5 is 20%. So they're using 5%. I don't know. Do we want to go ahead and let the cookies go around? Because right now, all I see is my eyes looking at cookies. So raise your hand if you want the cookie.
Thank you.
I can compete with a lot. I can't compete with a cookie.
Just focus.
Anybody else? No. Don't. I got a whole pot. Not even realizing what happened. Okay. Okay, so what happens? We go ahead. Depreciating at 20% a year, right? Okay, and so what? We're gonna depreciate at $2,400 each year. As we depreciate it, the book value of the asset comes down. Okay, what we call the net book value. So every year, same journal entry every year, guys, and my credit might show up the way I wanted it to, but it would be what? Debit to depreciation expense, 2,400, credit to accumulated depreciation, 2,400 happens every year for the next 5 years. Okay, now notice that what? The equipment account still has 13,000 in it, doesn't it? That doesn't change. It's what? Depreciation expense goes up, accumulated depreciation goes up. So if we take a look and we have the original cost is 13,000, $1,000 salvage value, 5-year life, 12,000 per year. If we were to prepare the balance sheet the day after we purchased equipment, what would happen? We'd have equipment, 13,000. We haven't depreciated it all, so the accumulated depreciation would be 0. The net book value is 13,000, right? But then in that first year, you can see this year 1 income statement here. I go ahead and I debit depreciation expense for 2,400, right? I credit the accumulated depreciation. And when I do, now my accumulated depreciation shows what? 2,400. Okay. to prepare the balance sheet at December 31st now, year one, after the first year of using this piece of equipment. On my balance sheet, right, my equipment, I'm just gonna put EQ for equipment, would still be 13,000, but the accumulated depreciation account at that point would show what? 2,400. So the carrying value of this asset, 13,000 minus 2,400, which you can see right here, I'm gonna show you that balance, but 10,600. Okay, we call that the net book value. We call it the net carrying value. There are different terms that get used for this. Okay, but notice that what? We still have a fairly new truck, and this presentation that you're seeing here at the end of year one is telling you that. Hey, you bought it for 13, its depreciation is 2,400, still got life left in it, doesn't it? Okay, now in year two, you do what? You again debit the depreciation expense, credit the accumulated depreciation. When you do, the accumulated depreciation account now has what? 4,800. When you prepare the balance sheet now at the end of year two, okay, you still got some life in this thing, 13 minus the 48, right? Year three, debit the depreciation expense, 2,400, credit the accumulated depreciation, 2,400. When we look at the end of year three, okay, little older asset, still has some life in it though, doesn't it? Okay, year year four, same journal entry. Accumulated depreciation now has what? Now has this 7,200. Oh, this asset's getting older, isn't it? Next year, year four, same thing. Now you're looking and saying, oh, this company has a fairly old asset, doesn't it? This presentation is allowing you to do that. Year five, we're showing what? We're showing that this thing only got $1,000 left in it. If you're looking at this balance sheet at the end of year five, you might be sitting there and saying, I don't know if this is my company, because what? I'm looking for a stock that I want to acquire where I'm going to be able to maybe get a dividend sometime soon from them. And they don't look like they're going to be able to pay a dividend. They're going to have to cop up pretty soon for some new equipment, right? This presentation. Or you might be looking at what? Sometimes students say, what's the more important statement, the balance sheet or the income statement? I say, how do I choose amongst my children, right? Okay, so what happens? You might be looking at the income statement in conjunction with the balance sheet and say, well, wait a minute now. The last time they got some equipment when they bought it, they were looking pretty good. If I look year over year, they were generating some nice income off of this. Let me invest so they can go buy and keep this thing going, right? Buy some more equipment. And I want my money to go towards that effort, right? Question? Okay. All right, good. Now, again, the salvage value, the useful life were estimates. And so FASB, remember FASB? Financial Accounting Standards Board. Look, guys, don't get me to that mode where I start flipping out because I know you're not counting, because I've been known to go around and teach the class from the back. And I will do that. I'm not here to hear myself talk. I have a real nice car and a real nice house. So it's real easy for me to get back into the nice car and go back to when I get there. Okay, so in some of the classes, there's windows in the back, and I can see what's on everything. I mean, you stop looking at those Woody Woodpecker cartoons. Okay, so what happens? We're sitting here and we have estimates, right? And so at FASB, remember the FASB? What FASB tells us is that every company has to put maybe the first or second footnote in their financial statements, this warning. That says, hey, the results may differ from what you're seeing here because there are estimates included in the financial statements, and that's kind of expected to be a common understanding. So I put this little objects in the mirror closer than they appear. Back in the olden days, you'd have that on the mirror. You don't see it anymore because now they have like a chip and it makes a little light go off if you're gonna pull into traffic or whatever, okay? For a while during the pandemic, they were saying, they can't get that chip anymore that does that, so they're thinking about letting construct cars without that chip. And the president at the time said, no, we're not doing that. We are not gonna allow cars to be constructed without that chip because that's a safety hazard. Sometimes it's important, a president who's had life experiences like, you know, they lost family members in a car accident, things of that nature. And so they didn't allow that to go through. Okay, so now they don't put that, but what that's telling you is, hey, be careful, right? Don't pull out, don't make a decision with, it's gonna kill you, right, based on what you're seeing here. Okay, so just put in a little bit of discretion into the discussion here. Okay, now, what happens? Let's say at the end of year 5, I sell the asset and I sell it for the $1,000 that I thought I would. Okay, now what happens? The equipment account, you can see I wrote up here, is still showing 13,000. So if I get rid of the equipment, do I need that equipment account anymore? Do I need that equipment account anymore if I got rid of it? So how do you decrease an asset like equipment? You credit it. So I credit the equipment for 13,000. If I got rid of the asset, do I need this accumulated depreciation anymore of 12,000? No. So I go ahead and I do what? I debit that for 12 to close it. So now I got rid of the accumulated depreciation and I debit the cash for $1,000 because I received $1,000 on this. The journal entry balance. Okay, now let's say somebody comes up and they say, no way, you've got, you know, that's the original delivery truck. It had these certain no more. How much you want for it? I'll give you what? Don't sell it for 1,000. I'll give you 2,000 because I really, really want that. Am I going to tell the guy no because I estimate I'm going to get 1,000? No, I take the money, I debit cash, I still debit the accumulated depreciation for 12 and what? Credit the equipment for 13, but now I will debit gain. I will credit what? Gain for $1,000. Credit that gain. Gain is like revenue in that what? It'll increase net income, but remember we talked last time that what? We report gains and losses in a separate section, the non-operating section, so that people realize, okay, you had a gain from sale of equipment, probably not gonna happen every day. That's why you didn't call it revenue, but we would report that gain on the income statement. Question?
So like 500?
If it sells for 500, what if the truck is sold for at 500? Did you put that in there? AI is getting real good. It hears the question and it puts it in the. Would be a disaster. Okay, so what happens? You come in and if it was only for 500, now what? That's gonna be a loss. Okay, because it had a carrying value of 1,000. We are only 100, debit the cash 500, we need a debit to make that journal entry balance. That's a loss that's reported. Loss is like expense, but we don't call it expense because it's not the day-to-day operations of the company. We break it out in that non-operating section. Remember the multiple step income statement, and we show it down there as a loss. Sometimes you'll see companies will roll everything into other revenue, other. They call it other. They probably shouldn't call it other, but they revenue, but they do. I see it, but it's always after operating income. It's always in a section that comes after operating income, or income from operations. Question?
I have a question.
Why is debit abbreviated DR?
I think it had something to do with when the nomads came up from Africa. I don't know. CR, you get it, right, Fred? Debit. I think it has something to do with Mesopotamia or something.
Okay, that just doesn't make sense.
No, I don't know. It's something way beyond before me. And so I don't know. It's like some sort of like Latin or something. It's debitus and credit.
Oh, okay.
Yeah. Yeah.
Thank you.
Just go with what I said.
Look it up.
Yeah, it's pretty much the same thing, right? Like-
It's one is Latin origin, says to O. There's historical abbreviation, early accountants abbreviated as DR from debitor.
Debtor and creditor, oh, okay. Okay. Which has nothing to do with it, debtor and creditor, because. That's not what we're doing, we're not saying, hey, you're a debtor because you got a debit, so I don't know what the hell to do, so, I don't know. Yeah, it's that kind of stuff. The best way to show it, I guess I could have said, I didn't even need DRCR, this is just. A bad habit. Oh, I see, you're medical.
Yeah.
Yeah, I was like Dr. Cash, Dr.
I apologize. I didn't mean to insult you. How dare they? Dr. Ken.
That'd be a cool name.
I mean, cash can cure a lot. Okay. But bottom line, this is a loss, it'll be down there, right? It'll decrease net income. Okay, good. Now, units of activity is another method, that's straight line. Units of activity is another method. Now, notice, guys, the depreciable base is the same, 13,000 for the truck minus the 1,000 salvage value, 12,000 depreciable base. What changes now is what we use in the denominator. Instead of using the years, we use the units of activity. How many miles we can drive this car? If it was a machine that's producing widgets, how many widgets will it produce? Whatever, right? Okay. And so we go ahead and instead of dividing it by the years, we divide it by the miles. And now we determine that this thing will depreciate at a rate of 12 cents per mile. And in the first year, they assume that they spend 15,000 miles. And so for the first year, the depreciation expense would be 1,800. Now, what happens? As you drive the truck, that determines the depreciation. Okay, so if you use the truck a lot, like this 3,600, you're gonna have more depreciation. If you use it what? Less, you have less depreciation. But the journal entry would be just like it was for straight line, debit to depreciation expense, credit to accumulated depreciation. The difference is what? The amount varies based on the usage of that asset. Okay. Which method do you think gives a more accurate depiction of the depreciation here? Straight line or units of activity? Units of activity, because hey, you use a thing a lot, you didn't use it at all, it probably won't depreciate. I mean, sometimes companies will use units of activity and they'll say, well, we're gonna start out with, $200 of depreciation because the wind blows and eventually this thing will turn to dust like all things. But if you could also argue if you don't use it at all, no depreciation, right? Okay. All right. So this is more accurate, right? We all feel that. But why did 83% of the companies use? Is there a question, Dick?
Yeah. Do companies arbitrarily pick 12 cents a mile or whatever, or is there like a standardized across the board?
Well, the 12 cents per mile came based on their estimate of how many miles they thought the truck would be able to drive.
Yeah, I guess that, okay.
And
Is that like
that,
an acceptable rate? I don't know, are people,
No.
I wonder if people can like get away with messing with their books by being
Well-
like, well,
well,
we're gonna lose a ton of money. We're gonna say this is gonna lose a ton of money, yeah.
well. Okay, there's a couple of things going on.
Yeah, sorry, I don't mean to-
No, let me unpack some thoughts that I'm feeling. The 100,000 would be based on their experience with other vehicles. Or maybe the manufacturer said, hey, you can get 100,000 usage hours or whatever out of this thing or miles, whatever. Or they called around and they got a number, right? Now, who do they have to convince that that number is reasonable?
IRS or.
Who do they? Number is reasonable?
Auditor.
They have to convince their auditors that that number is reasonable. They just can't come in and say. Well, look, man, you know, I'm thinking 100,000 miles, you know, the auditor's gonna say, well, you got something to show me, or, you know. You're saying 100,000 miles, I was just at a company yesterday, said the thing would last 50,000 miles. Okay, now, the motivation for a company, when you're talking about financial reporting purposes, external reporting, financial statements, which we're talking about in this class. You'd think the motivation would be what? To extend the number of miles so that the depreciation is less each year, right? Right, so that the net income goes up?
Yeah, I would assume, yeah, I assume that that's the case.
Yeah, okay.
I don't know, I feel like there's like all this tax law stuff that I'm talking with, that people would be like, wanna have losses, and then they write. I'm just thinking about,
Okay.
well, for something not paying taxes.
Stay on the range, Al. So far, we're understanding that what? That, for financial reporting purposes, we might wanna extend the years so that we have less expense and we show better net income, right? Okay, but you'd have to convince your auditors that that is reasonable. So if I'm an auditor, I say, well, this thing, you can drive this thing 2 million miles, you know, we're gonna drive this thing to the moon. You know, then I might turn around and say, I don't think so. You need to take another look at that, and I'm gonna need an adjustment for you to bring that to a more reasonable amount of time, right? That's that whole meaning. For tax, and again, I don't talk about tax in this class, but for tax, okay? The IRS has different types of depreciation, and IRS allows companies to use a more accelerated approach for depreciating their assets. Okay, so they can depreciate them over a much quicker time. So they might say, hey, you know, it's with the straight line, if you think the asset's gonna last 20 years, we'll let you depreciate it as though it's only gonna last 5 years. And you can depreciate it much more quickly. Now, if you can depreciate it more quickly for your tax reporting purposes, that's gonna bring your taxable income down. That'll bring your tax bill down. With the idea that companies will do what? They'll take that money and turn around and invest in more durable goods, property, plant, equipment, and that has a multiplier or an accelerator effect on the economy. When Congress writes the tax law, there's a lot of things that they look at, and it has often little to do with the logic of accounting that we're talking about in this class. It has to do with, well, what button do I want to press to make the economy go faster or go faster? Or who donated? Who contributed to my campaign? And what business opportunity is created for them if we can depreciate an asset over a different schedule? Right? That's politics, you know, and that's why after a while with the tax law. So I just had to study this whole thing about alternative minimum tax, and you find out that they put it into the code for one person. So that's why I don't like tax, but that would be sort of how I would unpack that conversation. Yeah. That's why they let you deduct your house interest. Does it make any sense that they don't let you deduct the the gas money that you pay to get to your job so you can earn money? But it makes sense to let you deduct the interest on the house that you live in that has nothing to do with your job? From an accounting standpoint, well, that's violating the economic entity assumption. What do they have? Supposed to do that. For tax purposes, they do it because they know that what housing drives the market, the economy, right? And so they allow that deduction unless you live in a state that you didn't vote. Certain people on power, and then they say, well, we're only gonna let you deduct this much. And the people that voted for that person, they're fine with that amount because they don't pay that much interest because their house only costs $5. Nobody wants to live in that state. No, there's no logic to the at all. Back to accounting, okay. Right, okay. Yeah, I think we've exhausted this, right? Now, notice what happens. The older the item gets, the less you use it in this example. And that's probably how something works as a truck starts to depreciate and it's losing some steam and you're like, oh, don't take it on a delivery, just use it for short deliveries and so forth, right? So the older an asset gets, the slower you tend to use it, the less you tend to use it. So what happens? We do have a method available to us called declining balance. And what declining balance says is we're going to calculate the depreciation as the book value, the original cost of that asset minus the accumulated depreciation, goes down. That's what we're going to base our depreciation on, declining balance. Now, I'm going to only talk about double declining balance, but you could all use triple declining balance, 150% declining balance, that's fine. Okay, the standards will allow you to do that. Okay, and so you take a look, and if straight line was 20%, double declining balance, we take the straight line and we double it for double declining balance, would be what, 40% per year? Okay, so what happens? It's based on the balance of the asset each year. So now we don't depreciate, the salvage value in the calculations, but we do know what the salvage value is and we won't depreciate below the salvage value. So now you start to take a look, and under this declining balance, oh, I forgot to ask you a question. I started to ask that question. So we've all had agreed that this was the better method. Units of activity was the more accurate method. So why did 83%, whatever that stupid number was on that other slide, why did 83% of the people, the companies, use straight line if this is a better method? It's easier. Straight line is what? Easier. Now, when we say easier, I don't think Tim Cook's sitting up there saying, well, we don't want our accounting department to work too hard. That is what? If you wanted to use the miles, then wouldn't you have to also track the miles? Yeah. Okay, now sometimes people say, well, that's not that hard, John. What was the miles at the beginning of the year? What was the miles at the end of the year? Difference is how much it got used. That's fine if we're talking about what? One truck. What if you're FedEx? You've got trucks, you've got planes, you've got little trucks, big trucks, right? And even if you say, well, we could use GPS and the GPS could download and say how many miles we use, and then we'd have all that information right there. Yeah, but then it would also have to do what? Update your accounting system so that your accounting numbers would come in. And all of a sudden we're getting to a point where what? The cost is prohibitive to using, say, units of activity as a method. Okay. Now, notice though that what? As the used it less and the depreciation was less. Okay. So what this double declining balance is going to allow us to do is we're going to sit there and calculate our depreciation based on the declining book value, double declining balance. Okay. So what happens? We take the, okay, we take what? The 13,000. We don't subtract the salvage value. By that double the straight line, which was 40%. That gives me depreciation expense of 5,200. In year one, I debit the depreciation expense 5,200. I credit accumulated depreciation 5,200. 13,000 minus 5,200 leaves me a declined balance of 7,800 for the first year. I take that 7,800, I multiply that by 40%. That now gives me 3,120 for year two. I debit expense 3,120 for year two. I credit the accumulated depreciation 3,120. 13,000. Now my accumulated depreciation is 8,320. 13,000 minus 8,320 leaves me a declining balance of 4,680. 4680 times 40% gives me 1872. I debited depreciation expense 1872. I credit the accumulated depreciation 1872. Now the accumulated depreciation is 10,192. 13,000 minus 10,192 gives me 2,808. I take the 808, I multiply that by 40%. That gives me $1,872 of depreciation. I take the 1872, now the depreciation is 10,192, 13,000 minus 10,192 gives me 2,808. 2,808 times 40%, so forth. I won't go through the whole thing because you'll go into a coma. What's interesting is notice that what? At the end of the last year, value of this thing is 1,011. And if I took 40% times 1,011, that would cause me to depreciate it below $1,000. So in the final year, when there's any amount left, I would just take that $11 of depreciation because I do stop at the salvage value. So even though I don't use it in the calculation, I'm aware of it and it's sort of there off to the side, right? The gains and losses on the sale are exactly like the thing that we saw for straight line. That would not change. Question.
So if we continue using this for year 6, we just stop at 1,000, then don't take any more
We
depreciation.
do not depreciate it anymore after that. That's correct. Remember that little things in the mirror are closer than they appear. So everyone understands, okay, it's not gonna turn out perfect. And sometimes, well, what if they're way off? Well, you know, they shouldn't be way off. That shouldn't have happened. They should have had a good estimating technique in place so that that doesn't happen, right? And if you say, well, you know, they're really getting 10 years out of these trucks. Well, then the next truck they buy, they'll use 10 years instead of 5, right?
And I guess to add to that thought, it's because you cannot change the years once depreciation has started.
Oh, no, you could. Okay.
Why would I wait for the next truck if I could do it with current asset?
Well, it's unlikely that you would sit there and say, well, I've got this $1,000 because the salvage value is a small amount to the you know, to the overall. So you would just let that 1,000 sit there, and the idea of materiality would say, okay, and we'll figure it out. But let's say I had a asset that I had paid $100,000. And let's say that I thought that that asset had a 5-year. And let's ignore salvage value for this. So that means it's gonna depreciate what, $20,000 a year? Okay, and in year 1, I debit depreciation expense. 20,000. The accumulated depreciation, 20,000. Right, if I tee up the equipment. And I tee up the accumulated depreciation. I'm not gonna do the expense. The equipment had a balance of 100,000. And the accumulated depreciation got 20,000 in year 1. Year 2, I make the same journal entry, assuming straight line. I debit depreciation, that's 20,000, I credit accumulated depreciation, 20,000 now. That's year 2, right? With me so far? Okay. During year 3, I decide that this asset didn't have a 5-year life, it only had a 3-year life. Let's make it a 10-year life. And that means it's 10,000 a year. And so my accumulated depreciation is 10 and 10. So I thought it was gonna have a 10-year life, right? And then during year 3, I said, this thing only got a 5-year life. It's about to fall apart. I might be able to get another couple years out of it, but 3 years out of it. For life. Okay, so at that point, the carrying value of the asset is what, 80,000? I take the 80,000. Right? I have already, I said it only has a 5-year life, but I've already depreciated what? 2 years, so that means that there's 3 years left. So this 80,000 divided by, maybe I should have said it would have 4 years left, so the numbers wouldn't come out. Okay, but at this point, 80,000 divided by 3 is what? How much per year? 26,000 what? Come on, guys, calculate. I'm not gonna take this stuff. How much?
667.
26,667. Okay, some sense, I assume, right? So now for the last 3 years that I'm reporting the use of this asset, I would debit depreciation expense 26,667, credit accumulated depreciation 26,667. So I go forward with the new estimate. Okay, so if there's a material change in what I think the useful life should be, then I'll make an adjustment and I'll go forward in years in this example now, 3, 4, and 5. I will use that 26,000, the remaining 80,000 book value with the 3-year life and take 26,000 per year for those. That's change in accounting. I don't go back and restate anything. We do not restate for a change in estimate. We do not do that because the little things, so full of estimates, things in the mirror, then they appear. We adjusted the financial statements, restated them every time we had a change in estimate. All we do is restate year over year over year in companies. That would be the thing for the markets. Okay. Okay, but if it's just, one more year, I got $1,000. Am I really gonna go back? Okay, let's do that so I can take, $340 a year. We probably mess with that. Okay, intangible assets, we've talked about a little bit. Okay, intangible assets are from fixed assets, and that they're not these, big giant pieces of equipment and so forth. Their value is based on what they allow us to do. And so it's sort of what, like a cloud, it doesn't really have this value. This thing is heavy, it must be expensive. We can't do that with what? With an intangible asset, things like patents, copyrights, etc. Okay. Now with intangible assets, you must acquire them from somebody else. So any money that you spend to develop a patent is expensed as research and development. But if you're doing the research and I then turn around and I buy that patent from you, now I will capitalize that on my financial statements based on what I paid for it at the time, because now there's been an arm's length transaction. Okay, now what happens when we're dealing intangibles? There are limited life, like a patent, I think has like a 17 years, 20-year life. I don't know the life, legal life patent, but you, 20, okay. So you will amortize a patent, thing like a specifically identifiable limited life asset, like a tangible asset, like a patent, over the shorter of the legal life or the useful life. So if you have, and I think I gave the example, the patent to make a flip phone, and you think, oh, okay, yeah, we're gonna churn out these flip phones for the next 20 years. Were companies able to do that? No, right? So you would use the shorter of the useful. And by the way, if you were using the legal life of 20 years, and then somebody invents something that just kind of obliterates the value of that patent, well, you write it off if it obliterates. But if it shortens it, you do something like what we did here, where you add and use a shorter life then at that point. So you could change in the middle of your amortization on it. Okay, things like goodwill, they say you know, indefinite life intangible, they're really talking about goodwill, okay? Nobody knows how long goodwill is gonna last, could last what, forever? Or all of a sudden a company does something stupid and all the goodwill goes away, okay? But you must evaluate goodwill for impairment each year. And the way you do that is you figure the market value of the company. And then you assign that market value to all of your, first you deal with your fixed assets. Then you go to specifically identifiable intangibles like patents and so forth. And if there is some amount left over, you can assign that to goodwill. And if the amount that you're assigning to goodwill is less than what the carrying value of the goodwill is, then you have to write that goodwill down. Write it down and you write it down till it gets to zero. And then you don't write it down past zero. You do not write it up. You cannot make goodwill gooder. You can only do what? Make it worse, and you write it down going through that pecking order. So the market value of the company, assign everything to fixed assets, then to what? Specifically identify intangibles like patents, and then if there's anything left over in that market value, take it to goodwill. If you don't have enough to cover whatever the goodwill is, you would have to write the goodwill down until you write it down to zero, and then you don't take it, you have negative.
What is the will?
Goodwill is a cloud. So let's say you go out, someone takes you out for Valentine's Day. And they bring you to this restaurant and all the seats are busted. The equipment is old and greasy. And you're thinking to yourself, what the hell is this? Why did they bring me here, right? And then they serve you the food and you're like, oh, this is the best seaweed fricassee I've ever had. And so you call the owner over and you say, oh, I'm looking around all the equipment and everything and you're building and everything. I think you got 50,000 worth of assets. I'll give you 50,000 for the place. And the owner says, security, how dare you? You say, okay, don't get me. How much do you want for the place? He says, I'll take $1,050,000. Okay, so what happens? If you had a company that all you did was sit here and take cash and buy restaurants and say you got some cash in this corporation that you created by issuing some common stock, some balance sheet balances, right? Okay, but now you turn around and you say, okay, I'm gonna buy the restaurant. Now, when you buy the restaurant, of course, now, and you give the guy $1,050,000, give him $1,050,000, because he paid for the equipment, plus he wants this $1 million. When you report your cash is now what? Zero. Your equipment that you now own, he's gone. The equipment that you now own is 50,000. And you have what? You have an intangible asset called goodwill of $1 million. And then you have common stock of $1,050,000. Cash and gave it to the guy. That's why I said it's a cloud. It is entirely based on this idea that you've got this goodwill because people are going to come to you and, you know, want to eat at this restaurant, right? Okay. Now, what happens? A little bit later, you accidentally drop some Clorox into the place. And now a bunch of people get sick. And so now it's like the goodwill is worthless. At that time, you would debit loss on goodwill impairment. Say GWM, goodwill impairment of $1 million. You would credit the goodwill for $1 million. Credit the goodwill for $1 million, now the goodwill is what? zero. And your loss would get closed out to retain earnings. And you'd have a negative $1 million in retained earnings. And the balance sheet would balance. Now, the way I did that, I just says, okay, $1 million of goodwill is worthless and so forth. The actual process that I was describing is you'd actually say, what companies need to do is they say, what's the market value of the company? They come up with the market value of the company based on the latest trades of stock or whatever it is that they come up with, not what we do in this class. Here's the market value of the company. You assign all that market value first to your tangible assets, then intangible assets that are specifically identifiable like patents. Then you assign it to goodwill. And hey, if the amount that's left over is more than the goodwill, you don't have to write down the goodwill. If it's less than the goodwill, you have to write the goodwill down to that lesser amount that's left. And if it completely wipes out the goodwill, you write the goodwill down to zero and you stop. There's no such thing as negative goodwill. Okay. So they say no amortization. Makes it sound like, oh, well, this will go on forever. No, you have to evaluate it for impairment every year. Okay, yeah, it says here 20 years. Okay, if you have to pay legal fees to successfully defend your right to a patent, so you bought a patent and now for some reason somebody's challenging your legal to that. At that time, if you are successful, you could add that to the value of the patent. You can capitalize that. What do you do if you lose the case? Expense the legal fees and write off the patent. Okay, and you would amortize it. In this example, by the way, guys, you're saying, well, why did they multiply it by 6/12? It's because they didn't acquire the patent first, so we only took half a year's depreciate amortize it.
Close. Trademarks.
Trademarks.
Yeah, like prominent ones.
A trademark, you can capitalize the cost of creating the trademark. So if you're the one that drew an S and decided for some strange reason to put a tree in the middle of it, say, okay, that's the trademark. Okay, then you could say, okay, that I can capitalize and maybe it has an indefinite life and you won't amortize it, but you could evaluate it for impairment. If I buy the trademark, the right to the trademark from you, then I can capitalize whatever I paid for that, right? And again, that could have an indefinite life. So a trademark does have to it, but it depends on how you acquire it, right? The cost that you pay somebody to make the drawing. I mean, think about if there's anybody that got screwed in this world, but think of the idiots that when they first started the football leagues drew, so Al Davis came up to you. So I have the Raiders, and he's the guy that owned the Raiders. I have this team that's going to be called the Raiders, and what I want you to do is I want a picture of a guy with the little swords coming and he's going to have a patch knocked out in his eye. And so the guy goes and says, okay, so here you go. Maybe $500 for it. You take a hat, plain black hat, without that, worth $20. You put that on it, it's worth $150. So you can capitalize that amount you paid for it. You can't say, well, now it's worth all this money. Unless I now come in and I say, well, for the right for that stupid logo, I'll go ahead and I'll pay you $10 million for it. Now I can put it at $10 million and maybe I don't have to amortize that because that may have an indefinite life. And when I go through that process of evaluating my market value of my company, I fix assets first and then intangibles with a specific, specific level intangibles, and I would include the patent, the trademark that you're talking about. process.
So the value of your brand would fall under goodwill.
If you acquire it from somebody else.
If you do, so Coca-Cola's brand. That. They did not acquire things.
So there's no goodwill.
No accounting value.
Correct. Yeah, because you'd start to get into the whole thing that FASB doesn't want, right? Which is companies just sort of creating value and putting it there. Meanwhile, there's no real objective measure of it. So it's bought from somebody else. Only recorded, by the way, when entire business is purchased. Notice in my example, I bought the whole business and that's when I recorded the goodwill. So it's not like you can come in and tell the guy, hey, I'll buy 20% of the company, and then you put goodwill 20% on your financial report. Does not work that way.
Not in a merger either.
No, not in a good merger either. Are there mergers where they only buy 20% of the company?
That's the value.
No, because what you'd have is the existing company with new owners, right? Yeah. Okay. Okay, good. All research and development costs are what? Expensed. Okay, current assets, you see some of the usual suspects up here. Property, plant, equipment are what? Non-current. Okay. What do we want to do? Chapter 11? What time is this thing supposed to end? 3 what? Oh, 5 minutes? Oh, no, we're not coming.
Sorry.
Chapter 11.
3:45 or 2:45?
45? Do I hear 3:45? Okay, yeah, we're not gonna beat you, so we'll have to do it. Question? No? Okay, guys, I will see you tomorrow. We'll get chapter 11 with some luck, chapter 12, right? Okay, all right, guys, I'll see you later. Oh.